Today we're ready to look at an actual general journal for a business. You see one on the screen here, and we'll talk about how to use this first book of the business. However, before we get into how this works, just a reminder, the video that I gave to you this past Monday, October 7, is very important. In that video, I talked about the second book of the business, the ledger, and we looked at a skeletal view of ledger pages. We'll look at an actual ledger later, but the skeletal view, the very outline kind of a view of the ledger, sometimes called T accounts, showed increased size and decreased size and debit size and credit size, that sort of thing. So this video will be based on that video from a couple of days ago. So it's important for you to review that when you have a chance, because it may help with this one. Now, I also told you earlier that of the two books of the business, the ledger is probably more important than this journal. The journal is a chronological record of what happened day by day in the business. And it's important because sometimes we want to know when a particular transaction took place. If so, we can look in this book, the journal. The ledger has those accounts we talked about. So that's probably more important to the owners of a business. He or she will need to know how much we have in cash, how much the office furniture is worth, how much the delivery truck is worth, how much money we owe, how much the business is worth. We can look at the account called owner's equity to see that. So the ledger is very important from that standpoint. But in order to get the information there, we need to know how to use this book of the journal and its relationship with the ledger. And we'll talk about that with some examples today. On your screen, you see, as I said, the general journal for the XYZ company. It has a page number. This happens to be page 10, and it has columns, an 8-column accounts. We'll look at that in a moment. Something called a reference column. REF stands for reference, and we won't deal with that right now. We'll look at that later in the course. And then there's two columns, a debit column and a credit column. Again, similar to the video from a couple of days ago. Debit means left, credit means right. And they're important in relationship to where this information is going to go. The journal tells us not only the chronological record of what happened, but it tells us where to put this money when we do that process called posting. Posting means taking information from this book and putting it into the second book, the ledger. So those are the parts of the general journal page. It can get more complicated than this, but we're going to keep it fairly simple to begin with. On the right, you see that I've given you some information. To the left is the general journal of the XYZ company, and below are some transactions for the month of October 2019. Now, what I will be doing is showing you how to journalize this or these transactions. There are 5 of them, and they will be journalized sequentially, and eventually we'll show you how they go from here to that second book, the ledger. So again, we need to understand increased size, decreased size, debit, credit size, all of that in order to put this in the journal properly, so that we then have a guide to show us how to do the posting that we would do a little later in the course. First of all, the bookkeeper, the accountant, will be recording these transactions. October 1st is the first one, and let's look at it. Made sales for cash, and this could be the total amount of sales for the day. We received $400 from customers. We don't care who they are at this point because we got their money and we made some sales. So in every transaction, there are at least 2 parts. Sometimes this whole process that you're learning in Accounting 1 is called double entry accounting, because there are always 2 parts to a transaction, 2 parts to journalizing, and eventually 2 parts to the process we call posting to the ledger. So we call it sometimes double entry accounting. So we look at this entry and we have to decide what two accounts will be involved. And those accounts, as I said in the video a couple of days ago, these accounts are in the book called the ledger. And there is a sales account, that's a revenue account, and there's a cash account. Now, I've journalized this transaction, and it's really a simple process once you get used to it, and hopefully you'll get used to it pretty quickly. So I show you on the left in the journal how this is done. We put the date of the transaction, okay, October 1, 19, and then in this part of the journal, we put the two accounts that are affected. Sometimes there are even more than two, but right now there are just two. There's a cash account and there's a sales account. Now we have to think about not only what accounts are involved, but how they will be affected once we get to that book called the ledger. So in a cash sale, as we indicate in our transaction, obviously we have more money. And if you remember back, I told you that we need to understand the increase and decrease sides of every account. You remember that cash is an asset. Cash, you should know, and all assets increase on the debit side, the left side. So that's how it's going to end up in the ledger. And we need to have a similar situation in the journal when we record this chronological transaction. So we will put on the first line, and typically this is generally accepted accounting principles. Generally, when we do the journalizing, we start with whatever account is debited. Whatever account will be debited. Sometimes that account will be increased or decreased depending on what kind it is. Right now it's an asset. But the debit goes to cash. Why? Because cash, we got more cash. So it is increased. And we should know from that previous video that increases are shown on the debit side. That's why we put cash here, and in the debit column we put $400. That will indicate to us that that $400 will go to the debit side of cash when we get to the next step called posting. The other account is put on the next line. We go down a line and we see that this is again, generally accepted accounting principles is that this is indented. It doesn't have to be, but it just makes it easier to see what's happening in the journal. So the other account involved here is sales, because we made sales. That's what our transaction said. And in sales, we increased the amount of revenue. So that means this revenue account called sales will be increased. If you remember, again, from that previous video, this is going to be shown on the credit side. So sales is put here, and the 400 is put on the credit side. So again, as in all videos, you can stop and rewind this and listen to it again if you need to. But both accounts are increased, right? We got more cash. Cash is an asset. It's debited. We got more sales. That's a revenue account. They increase on the credit side. And the last line is simply an explanation of what happened. Here it's pretty simple, but in some cases it can be more complicated, but this explains what that transaction was all about. Now I'm going to go through these other transactions here fairly quickly, so again, you may need to go back and listen to this again to make sure it sinks in. Let's look at the next transaction. October 2nd, so we put the date in, and we look at this transaction, made sales on account. Again, we made sales, but we didn't get cash. Customers charged their purchases, and we don't know who these customers are. We'll worry about that much later, but they charged it. If you remember, way back when we look at financial statements, in the balance sheet there was an account called accounts receivable. That means this keeps track of money that people owe to us. That's considered an asset account. That account is debited. okay, because it is an asset account and it goes up. So we debit that by the $1,200, which is the amount of money that was charged. So customers charge this. So this is an asset. Assets increased on the debit side. We didn't get any cash this time, but we did make sales. So again, we credit sales, again, by the same amount. Every transaction has two parts, and every transaction is kind of a mini balance sheet because it has to balance. The debit has to equal the credit. Okay, so explanation. Sales on account. Next one, October 3rd. The store paid heating bill for cash. Okay, what two accounts are involved? Well, cash, obviously we're paying money now. Now that's an asset. Assets decrease on the credit side. It shows decreases on the credit side. So cash, we know, is going down, and probably that means we will credit cash, which is what we will do. But what about the debit? What about the other part of it, the heating bill? The heating bill is probably not the name of the account. The name of the account might be, it's an expense account. This is the cost of doing business. Heating expense is the name of the account. And expenses increase, if you remember again the previous video, expenses will show increases on the debit side. We paid more heating expense by $300, and we paid cash. So now cash is credited because, again, an asset shows decreases on the credit side. And when we write a check, that can serve as our explanation. So this is what? Check number 501. Okay, so we can go back to our checkbook to look it up if we need to. So these are the two expenses involved there. The next one, October 4th, store paid on account, something that the store charged last month. So we bought something last month on account. So we got supplies or we got something and we charged it. And that involves a liability account. We owe more money. And remember, liabilities increase on the credit side. Again, you simply have to go back and review that video and memorize this because it will be very important. So this, when we buy something on account, this is using accounts payable, which increases on the credit side. That happened last month. But now we are paying for it. So that means we owe less money. So the account that is used here that goes down is accounts payable. That's a liability account. We owe less money. Accounts payable will show decreases. We owe less money on the debit side. So we paid $500 and we paid, I believe we paid cash. So again, cash is the asset. Cash goes down, so that means any asset is showing a decrease on the credit side. So 500 goes on the credit column. So we have check number 502. Okay, so we paid on account. You have to remember that accounts payable is the liability account. It decreases on the debit side. And the last one, the store bought office equipment on account. Okay, we didn't pay cash, we charged it. So accounts payable is going to be used again. We owe more money, but we bought an asset. Office equipment sounds like an asset, something of value that we own now. So we got more office equipment. That's what will be debited. And the amount is $3,500. And we didn't pay cash this time. We charged it. So again, accounts payable is the liability account, and that's what's used. And